What's up, people? It's Kenneth here, 100 Years of Wealth, streamhomeloan.com, with a quick video for you. Whether you are in the industry as a mortgage loan officer yourself, or if you are looking to get into the industry, or you just have some general interest in learning more about home mortgages and financing, this should be helpful for you. So in our industry, the most common loan that is done is a Fannie Mae or Freddie Mac, but mainly Fannie Mae, which is a conventional loan. So let me answer that question to start off. What is a conventional loan? A conventional loan is a loan that is backed by Fannie Mae. What is Fannie Mae? Fannie Mae is a government-sponsored enterprise or institution that they don't lend money, or they don't originate loans. They back loans that lenders originate to their guidelines. So Fannie Mae sets a set of guidelines that are considered conventional loan guidelines, and lenders originate loans to meet those guidelines, and because they meet those guidelines, then they are able to sell them on the secondary market to Fannie Mae, which basically, like, a lender is not going to originate a loan for $500,000 and try to collect payments on that for the next 30 years. Some scenarios they do service loans. A lot of lenders obviously do service loans, but generally speaking, they'll originate a loan and then sell it to a secondary investor. Fannie Mae is a secondary market investor. They buy up a large portion of loans that are originated to those guidelines, and other institutional investors also do that as well. But those institutional investors are doing that because those loans are based on Fannie Mae standards. So Fannie Mae says, hey, if you originate a loan that meets these set of parameters, then we will buy them, as well as other investors are likely to buy them, because these are considered, strong assets. These are considered loans that have, that meet a certain criteria. Therefore, there should be a certain amount of repayment, or a certain ratio of repayment, compared to, if they weren't loans that were originated to a certain set of guidelines, then maybe there's going to be a different risk associated with it. But so Fannie Mae, and then you've probably heard the name Freddie Mac. Freddie Mac is another government-sponsored enterprise that sets guidelines. And traditionally speaking, or generally speaking, those guidelines for Fannie Mae and for Freddie Mac loans, Fannie Mae being conventional, Freddie Mac being conforming, those guidelines are generally similar. You know what I mean? Like, a lot of them are really similar, but what you will find is that there are certain things that one investor allows versus the other. So I'm not going to dive into that right now. Maybe I'll touch on a couple of little specific points that kind of stand out between those two investors. But the guidelines are always, I don't want to say always, but guidelines do change, guidelines do adjust. So unless I was going through the guidelines at this moment, I wouldn't really want to be like, hey, this is a guideline from the past. So it's always good to check on current lending standards, current lending guidelines, just to be sure, especially when it's something that might be unique or outside of your traditional, bracket. So just to go back, so Fannie Mae sets the guidelines on conforming loans, on conventional loans, and your Freddie Mac sets the guidelines on conforming. Once again, most of the time those guidelines are going to be very similar. So what you'll have is that at most lenders, you can get a approval through either Freddie Mac, which is, their system is called LP, Loan Prospector, or you can get an approval through Fannie Mae, and their system is called DU, Desktop Underwriter, and it'll work for their conforming conventional pricing. Most lenders have one set of pricing for what they consider a conventional or conforming loan, and on the back end, you can run an approval through Fannie Mae or through Freddie Mac and use that for your conventional financing or your conventional conforming financing. It's usually one thing. At some lenders, you will see when you run their pricing, they have pricing for Fannie Mae conventional, and then they have pricing for Freddie Mac conforming. So, at different times, you may be posed with the choice to choose one one entity over the other. And what I find is that the reason why someone may go with Freddie Mac versus Fannie Mae, conforming versus conventional, unless it's a pricing thing, which I usually don't see. Usually if a lender does have different pricing for those two entities, you're gonna see that most likely conventional is probably gonna have a little bit better pricing. It's rare that you even see a separation in pricing on those on that program. But when it does happen, it's usually going to lean towards conventional, Fannie Mae having a little bit better pricing. But what I've noticed is that, and let me backtrack this. When you run a loan, or let's say you're submitting an application, you're going to do a conventional loan, and it's a standard scenario, 30-year fixed. The loan amount is under the new conventional conforming loan limit for the county. Let's say it's $970,000, which is the max loan amount for like a high cost area, like let's say Los Angeles. So those are the things that are going to point you in the direction to say, okay, I'm going to be able to likely qualify for a conventional loan. It's under the max loan amount that keeps it from going into a super conforming or a jumbo category. The person's credit score meet the minimums that are required for conventional conforming loans, which is usually going to be 620. I think at a more aggressive time in the industry, I would see conventional loans be allowed to go down to like 580. But for the most part now, most lenders are staying around 640, and some lenders are allowing it to go to 620 for a conventional conforming loan. So when you're working with a client and you see that their parameters are fitting into this, they're documenting their income, their credit scores above the 620 or 640 mark, depending on your lender's overlays. Because lenders, Fannie Mae and Freddie Mac might say, hey, we're okay with a 600 FICO score. You'd obviously have to check their current guidelines, but Freddie Mac and Fannie Mae might say in their base guidelines that, hey, we're okay with a 600 credit score, but a lender can still put an overlay on top of the guidelines as to what they're willing to originate, just to give them that extra security or that extra layer of risk protection, I guess you could say. So when you're submitting when you're taking your application, you've looked at this scenario, you generally think that the client should be able to fit into the Fannie Mae, Freddie Mac guidelines. Prior to submitting a loan and moving forward with the lender, you're going to run the AUS, which is the automated underwriting system. For Fannie Mae conventional loans, the AUS, automated underwriting system, is called DU. That stands for desktop underwriter. So basically, when you have a full 1003, your full loan application in the system, you've run credit in the system, your liabilities are populated into the system. Once everything's complete and full, within your loan origination software, you have the ability to run your AUS. You should have your login credentials from the credit provider that you're using. For most people in our company, we're using Credco CoreLogic. So when you sign up with them up front, they give you login credentials to run your DU, which is a desktop underwriter. Login credentials are not required when you're running Freddie Mac. They usually just have like a branch ID that you run along with your credit report reference number, and you're able to run through their automated underwriting system, which is called LP. So for conventional loans, that's Fannie Mae. The automated underwriting system, the AUS, is called desktop underwriter. If you run your application through desktop underwriter and it gets an approval, it's called approve eligible. When you run, let's say for some reason you're like, I'm seeing better pricing on the conforming side, on the Freddie Mac side, and I just want to run the approval through that. You can run the approval through Freddie Mac. LP, which is a loan prospector, that's their AUS, their automated underwriting system, and then it'll kick out an approval or a denial. Their approvals are called accept, so it'll say accept eligible as opposed to approve eligible. So just slight differences that basically mean the same thing. Basically, they mean that you've met the guidelines and the automated underwriting system has read the credit report, read the assets, read the job history, read the income, the debt to income ratio, and giving you a answer as to whether you're approved or not. So once again, for conventional loans, Fannie Mae, the system is DU, Desktop Underwriter, and if you're approved, it'll kick out an approve eligible. For Freddie Mac, it's LP, Loan Prospector, and it'll kick out an accept eligible. If you're not approved, it'll go to what's called refer eligible, or it might say caution, depending on the reason for the approval or how far, I guess, you are away from being approved. Like if you're just so far from being approved because of your credit history or whatever the case is, it'll say like caution, refer with caution, or refer, it might say refer eligible, meaning that some things work out for the parameter, but there's a factor that's kicking it back, so that's why we're referring it, and maybe you try to manually underwrite the file. But I just wanted to kind of touch base on what a conventional loan is. So the other reasons besides, let's say, pricing, as to the reason why you might choose, you're going with Freddie Mac conforming versus conventional, is just because you were able to get that approval. Usually what we find is that there are certain scenarios where Freddie Mac LP will be a little more flexible than Fannie Mae. So in a scenario where you run your approval, and a lot of lender systems will allow you to run both at the same time, but in a scenario where you've run your approval and you're getting denied through Fannie Mae, you ran it through Desktop Underwriter, it's coming back with a refer eligible, you read through the findings, and maybe it says, lack of assets. It'll give you like little parameters as to the reason why. They're not 100% specific, like this is the reason why you're getting denied, but it'll say these factors contributed to this decision that was made. So, when you look at that, maybe you could say, okay, hey, let me ask the person if they have some assets in the bank somewhere that we didn't document. And if so, then you put that into the system, and then, maybe the approval comes back, okay, you know what, you now showed 6 months worth of reserves in the bank, you're approved. That's a factor. Or maybe the person can put more down if it's a purchase scenario. That's a factor. Or maybe if it's a refinance scenario and the debt ratio was kind of high, you go in there and you change the application to say we're going to pay off some debt through this transaction. Those are all ways to possibly adjust a scenario to actually get a loan approval. Obviously, when you move forward, that's going to be the new scenario that you're going with. But that's how you kind of play with the system to see what it's going to take to actually get the loan approved, and get your accept eligible or your approve eligible. But what I found is that while Fannie Mae usually requires your debt to income ratio to stay below 50%, like literally they're not going to allow you to go up to above 50% unless someone could tell me in the comments that they've been able to get Fannie Mae to go up above 50%. That would be great. That's interesting. But in my experience, Fannie Mae is literally 50% or below debt ratio in order to qualify. And usually if you have like a high loan to value, low credit score, not much assets in the bank, they're probably going to require you to stay below 45%. But if you're putting a good amount down, you have good equity on a refinance, you have very high credit scores, that's when they're going to be a little bit more flexible with that debt to income ratio maximum. So keep that in mind. Now, what I've seen is that Freddie Mac in certain scenarios will allow you to go above 50%. These are things that are like knobs that they can turn, where they can turn it up a little more to be a little bit more flexible, or they can just kind of tighten it a little bit to not be as flexible depending on the industry or the market. So consider that things do adjust and change. But I've seen scenarios where running Freddie Mac Loan Prospector, we were able to get debt ratios as high as 50.5%, so like 50.5. So when going a conventional conforming loan, that's pretty good. That's very flexible to be able to go above 50%. And sometimes that small amount actually matters, and that's the reason why someone is able to qualify for their transaction, just that small difference. So keep that in mind when you're running your approval. If you're running through a conventional conforming scenario, most of the guidelines are going to be the same, but there are going to be certain things that Fannie Mae and Freddie Mac look at differently. I'd have to double check the current exact guideline, but this is just another example. On student loans, I'm pretty sure that while Freddie Mac will allow you to use a documented payment for student loans, well, no, let me take that back. I'm gonna put it on you. Check the guidelines. There are differences in how Freddie Mac and how Fannie Mae look at student loans. So, you know, it's something along the lines of like if a student loan is deferred, let's say you have a student loan that's deferred, there's no payment being made on it. Fannie Mae might currently allow you to or require you to use 1% of the balance as the payment, while Freddie Mac allows you to use a documented payment, something along those lines. That's I'm not trying to be exact there, but I just want you to understand there are slight differences on how they look at things. So I wouldn't want you to take what I'm saying right now as like the gold standard anyway. What you always want to do is just understand that when you are in those scenarios where maybe there's something kind of holding your transaction back, understand that different underwriting engines, underwriting guidelines are going to look at things a little bit differently, even within the same program, right? So, you know, we're not talking about FHA right now, but FHA might look at student loans differently than VA. This is how you become more well-versed, because you're like, hey, I have a scenario that isn't working out because of this. Let me see which investor within what I'm trying to do works with it. You know, maybe I am able to go Freddie Mac because they're going to allow me to use a documented student payment versus Fannie Mae that's going to make me use 1% of the balance. Because if you look at it, if some people have student loans where they're paying $20 a month for like a $20,000 loan, that's great because that $20 is very low and it's going to hit your debt ratio for a very small amount. Now, if that loan is deferred and they have they're not making a payment, and Fannie Mae makes you hit them with 1% of that balance, that's going to be a $200 monthly payment. Maybe their debt ratio doesn't work out with that higher payment. And for people that have bigger amounts of student loans, that definitely has a higher impact on their monthly expense. So, just want you to consider that Fannie Mae and Freddie Mac are generally going to be very similar with their guidelines, but there are little things that could benefit you going one direction or the other, and it really benefits you to look into it, ask underwriters the different questions, take a moment and ask your account executive that you're working with, hey, what are the differences on conventional and conforming? And for the most part, if you don't have to, like if it works with Fannie Mae and there's your conventional side, it works well there's no pricing difference by going conforming versus Fannie Mae, then of course just go. But if you have a scenario where you're like, this one's not getting approved Fannie Mae, but it looks like it fits into the guidelines, but the automated approval isn't working, run it through Freddie Mac. Look at the difference in their guidelines on something, like if you're having an issue because of your student loans, look at their guidelines, see how they look at it. It might open up another option for you. So those are the generals on Fannie Mae and Freddie Mac. If you look at I think it's called the 4001 handbook, it's like the HUD handbook, gives you the true base guidelines for Fannie Mae. That's where you'll find conventional guidelines, and online you can also find the true base guidelines for conforming Freddie Mac loans. You can literally just Google it and you'll be able to find I forgot exactly how they categorize it. I should have done a little better research, but it's like, your single family residence or residential lending guidelines or something like that, but it's not hard to find. And you can also go directly to a lender you're working with and ask them for their guidelines. But I think it's really good to know where to access Fannie Mae's specific guidelines on their own, because there's actually been times where I was able to point something out to an underwriter and say, no, look, Freddie Mac or Fannie Mae says this works. Are you guys able to go off of this? Are you guys able to use this? And most lenders are, unless it's like a hard overlay that they've put in place, then most of the time they're going to be like, okay, I see what you're saying. Send me a screenshot of that. Send me the link to it, and we'll go with what Fannie Mae or Freddie Mac says if we're doing that particular program. So that's how you become a strong loan officer. That's how you become resourceful, and that's how you get deals through, because a lot of times an underwriter might just be just as new as you. An underwriter might only have a couple years in the game and been working with a certain lender that did things a certain way, and now they're in a different place and they're going off of some old knowledge. So I think it's beneficial for you to know those things and know where to find answers, up-to-date current answers, so that you are able to think outside of what an underwriter is telling you or what you're seeing in someone's guidelines. Because if you know that Fannie Mae or Freddie Mac does something in their guidelines, even if a current lender that you're working with isn't doing it, you can find a lender that's probably adhering closer to the guidelines and doesn't have an overlay that might be hurting your transaction. So generally speaking, like I said, conventional loans are going to allow you to go down to about 620 credit score. Conventional loans are a lot of lenders now are putting like a 640 minimum on that as an overlay, but generally speaking, 620 is like the bar for conventional loans. Right now, in most counties, or in high-cost counties, the conforming loan limit is 970,600. Could be off on that one, but that's another thing you can go and Google. Current county, current Fannie Mae or conventional loan limits for 2020. That's what usually will pop up. And then you can put the county that you're trying to verify, because it does vary county by county. You might have a county that is has a reduced max loan limit for some reason compared to just like the general standard, and then compared to the high cost areas. So something you always want to check out. When you're running a conventional loan approval, what will happen is if the loan is approved, you'll get a desktop underwriting approval, DU approval, and same thing, you'll get an accept eligible if it's through Freddie Mac, and it's going to give you basically a list of, it'll basically tell you why the loan got approved and then the required items that need to be verified along with the loan. So, or like to close that loan transaction. So in certain scenarios, like if someone's had a job and they've been there for a while, they have great job history, they have strong income history, credit's good, you might have a scenario where the desktop underwriting approval comes back and it only requests a pay stub, provide one pay stub, or it might come back and say, hey, provide a written verification of employment, and that's all that they're requesting. Or you might have a scenario where maybe the overall compensating factors aren't as strong, and it asks for 2 most recent pay stubs, a written verification of employment, last 2 W-2s, and the previous 2 tax returns. So you have like 2 spectrums of where it can ask for literally every portion of the income documentation, or the lease verification, which is probably just like a written verification. Some scenarios, I think I've even seen just a verbal. Well, no, I think it's been at a minimum, Fannie Mae, Freddie Mac are going to ask for a written, maybe along with the verbal verification of employment. But my point is that when you run your approval, it's going to basically tell you what you need to verify based on what you input into the system. So when I talk to clients, I kind of describe what an automated approval is. Kind of say, hey, look, automated approval is kind of like our golden ticket to get through our loan transaction or to enter into our loan transaction, because based on the information I've submitted into the system, it's saying, hey, as long as you can verify this information to a physical underwriter, then you're approved. So it gives us our list of required documentation. A lender could always look at the file and come back, and an actual underwriter can say, okay, along with that information, we need this as well. So don't think that will stop an underwriter from making additional requests. Usually, generally speaking, an underwriter is going to adhere to what Fannie Mae's automated underwriting approval says, or what Freddie Mac's automated underwriting approval says. But they do have the ability to say, okay, I seen this on the loan application. Can you ask for this from the client? That's not out of the realm of possibility. But a lot of lenders, it's like a selling point that, hey, we stick to what is being requested in the automated underwriting approval. They don't want to seem like a lender that's adding additional requests on top of that and bogging down your approval, because a selling point for them is getting the loan through quickly, not making it a stressful transaction, not asking for additional things that aren't being requested through the approval. So, you know, it really depends on the scenario. So, you know, once you have your approval, you can look at that and find out what a lender is going to likely request. That gives you the best chance to submit that up front and really have like a very quick approval, very clean approval, because for the most part, a lender's going to read that and say, okay, where are the documentation that support what you put into the system? And as long as you provide it, and there's not any like weird one-off circumstances in your application or in your loan scenario, then you should be good to go. I think that's pretty much it, man. Like and subscribe. This is some information that should help you grow your knowledge, and you know, conventional loans are going to be what you probably do the most of as a mortgage loan originator. So it's really good to be well versed on that. When I first got into the industry, all I did was conventional loans. I was running like 10 automated approvals a day because I was working at like one of the busiest direct lenders during one of the biggest refinance booms. So I was just doing so many of those automated approvals, I became very well versed on it. And you know, you realize like that it's a pretty streamlined system, and it has been for a long time. And most clients are going to fit into the parameters of Fannie Mae or Freddie Mac, which makes your job easy. So I think the main thing you should take from this video is that there's a lot of different nuances within that. Know where to go to get information. Google will direct you to the HUD handbook for Fannie Mae, and Google, you should be able to find Freddie Mac's guidelines as well, so that you know the true base guidelines for conventional conforming loans, which is going to be, once again, the thing that you do the most of as a loan officer. And you know, the better you know those guidelines, the better you're going to be able to catch things that are slipping past the underwriter, the better you're going to be able to see if a loan's likely going to qualify up front and waste less of your time, and just overall be a better professional. So thank you for checking in. I hope this video helped you out. We'll be back with some more, a little bit more specific training and material related to conventional and conforming loans. But for now, hopefully this guided you a little bit into what to kind of expect, and where to kind of look when you are working on a conventional conforming loan. All right, thank you. Put some comments in the questions. I'll definitely reply, or you can send a message to my message, email, whatever, and I'll definitely get back to you and answer your questions. Have an excellent day. Thank you.